So let me take this opportunity to welcome you to this semester's sessions. We are doing financial management, which is a paper in intermediate level, and is one of the areas where you normally cover some of the things which we have already or we are doing currently in our areas of work. And I hope that you are going to be having a very interesting semester. First, I will start by apologizing, by the way, for starting my classes too late, because I know right now we should be in topic 2. But due to some of uncertainties which we could not be able to avoid, is better we start later than never. So let me take you through our content and how we normally split it for better understanding. There are always 3 areas which I normally give students their notes so that they can be able to pass through them. They are around 4, actually. They should be 5. One should be the overview of the financial management. If you can go through my WhatsApp group, you will be able to see being able to share these notes with you, overview of the financial management. I was also able to share the notes which also includes the financial decisions, the areas under the financial institutions and markets. We also normally have the area which already I shared a PDF of its own called Islamic Finance. These are the areas which I expect students to be able to read on their own time. But during our blocks, we are going to be measuring the areas which we were not able to understand. For example, I can be able to prepare the blocks for certain settings. And these settings which we are putting in place, they are going to be helping us to showcase what we have done in class, the videos that we have done throughout the semester, and also the questions which are being put in place by the examiner. But that being said and done, my first topic, which I normally do, and I will able to request you to allow me, I normally discuss much about the areas which we are going to be computing, and those are, we are going to be starting with the topic 4, that is the time value of money. And when we discuss about the time value of money, it is a concept that you're going to be enjoying too much, but I don't want to expound it much. Let me just go through it. We are going to be studying things in this topic which are going to be assisting us to understand the financial management throughout the semester. The knowledge that you are going to be gathering in the time value of money is going to be assisting you in understanding all the topics which you're going to be covering, because this is the only topic which is usable in all the areas in financial management. So it is an area where you need to understand this concept of the time value of money and how it normally works. I'll just be able to give an example here, because the time value of money, we understand well, it comes with a point of investment and the risk which is going to be involved. And in this area, we are going to be determining the future value through compounding. And we are going to be determining the present value through the present value through compounding. So we are going to be looking on the compounding and the discounting of the expected cash flows when we are going to be checking on it. And later on, I will be able to expound about the compounding techniques and what is the meaning of the word annuity, what is the meaning of the lump sum, and how do we have to compute and understand the time value of money and also the formulas being used. We normally also have the financial asset valuation. And under the financial asset valuation models, we are going to be looking on the names which are used to mean different concepts or the different terms in regards to the securities which you are going to be valuing. And basically the securities which we normally use here, we normally work with the bonds, we normally work with the preference share capital, and also we normally work with the ordinary share capital. Basically, we normally talk of those being the areas which which the organizations normally use to finance its operations. So the theories of the valuation of the financial assets are always tested much, but they are part and parcel of our notes. So directly in this point, in our next class, because I have already shared the way the classes are going to be attended there and the dates are included. We can be able to see, we are going to be checking on the valuation of the redeemable, irredeemable, and convertible debentures. And sometimes we might be asking, what is the redemption of a certain bond or debenture? And you can be able to tell me that the redemption of bonds, it means these are the bonds which have a maturity period. And upon that period, you are going to be enjoying only two things. We are going to be enjoying the redemption value and interest, right? So the point of understanding the time value of money now comes in, whereby you have to be understanding the concept of the annuity. Do we normally receive the interest annually, or is the redemption value? And I will be able to tell you, for example, right now, we are waiting for the shares which we have already invested, or for the securities which you have invested to yield some interest and dividends. There is a dividends which already you invested in a fixed deposit account. For example, you put there 1 million, and that 1 million you are able to invest. You said under the terms that the interest which is going to be paid should be sent direct to my M-Pesa. So it means the principal amount is going to be remaining the same. So under this concept, it means when we are going to be enjoying our interest will be the same. And that is what we are going to be learning today, the concepts of annuities and lump sum. Lump sum, it means only once. Because upon the expiry of the period which you have already invested, it means you have to redeem the principal amount. That is the redemption, the valuation of the redeemable bonds talks about. Also, let me explain about irredeemable bonds. And these are the bonds which they don't have a maturity period. And these bonds are always rare. So what are they going to be promising us? They are going to be promising you interest to infinity, right? So that is one concept which you are going to be learning. Then the other one is going to be we are going to be discussing about the convertible debentures or bonds. So the conversion concept normally is an option which you are normally given as an investor upon the maturity of your security. Rather than redeeming, you can convert them to other securities. And in this case, we might be converting these securities to ordinary shares. And that is the option which you're normally given there. And then you're going to be comparing between the redemption and the conversion, which one has more money. Remember, when you are investing, you are playing with the risk and also the money which you're going to be getting back. And that is the same concept you're going to be looking when you're doing the preference share capital. But when you look on the valuation of the ordinary shares, we normally use different method to value our ordinary shares. We normally use the net asset basis, the PE ratio basis, which we are going to be learning it again under the ratio analysis, capitalization of the earnings basis, Gordon dividend growth models, finite earning growth model, super profit model, Walters model, discounted free cash flow, residual income model, among all those models incorporated there. Then we have another topic which we're going to be learning, and this topic is very interesting. What are we going to be discussing here? The introduction to capital structure decisions. It is a topic which you have to be learning today, and also you're going to be learning it under advanced level. So it is very important for you to understand it fully now, because you're going to be using this topic to expect you to gather more information, to gather more knowledge about the cost of capital, the practical application of the cost of capital components, among other aspects. And this topic you're going to be enjoying because we have to be looking on which securities do the organization use to finance their projects. And in this case, when we discuss about the WSEC, it means yours is the analysis of the existing capital structure of the organization. When you look at it, it means you are going to be checking on this organization on how are they financing their existing capital structure? What criteria, what securities are they using? And it means we cannot be able to alter with their optimal capital structure of the organization. And that is what we discuss about the WSEC. Even if we are using the WMCC, we cannot be able to factor or to alter with the existing capital structure. But when you look on the differences between the two, one is historical, the other one is futuristic. And in this case, you need to understand that when you are dealing with the futuristic aspect, it means yours is the analysis of the existing capital structure, but you look on the areas which you can be able to capitalize by use something called breakpoint in a point of making more money or looking for more money to finance the new projects in which the organization need to undertake. And that is why we are going to be looking on the differences between the two. Under the WMCC, you are going to be learning something called the breakpoints. Later on, we shall be able to look on the leverage and risks and the analysis of operating profits as we conclude on that topic when our times comes. Now, we have the introduction to capital budgeting decisions. And the reason is why they are calling them introduction, because this topic are still existing under the advanced level. And when we are going to do that advanced level, we are going to be looking on the capital budgeting decisions. And in this case, we are going to be looking at what ways do the organization need when they get more funds. Sometimes you normally look at it and say the organization can do research and development. This organization can be able to expand the existing projects, right? And among other things in which they have to be doing. And the capital budgeting decisions is whereby we are going to be using the aspects of the techniques of measuring risk, right? Let me call them the investment appraisal techniques. And these investment appraisal techniques, we normally have some powerful models, which we call them modern techniques. We also have traditional techniques. Under the traditional techniques, we normally have the accounting rate of return, and we normally have the payback period. But when you go to the modern techniques of measuring risk, we are going to be discussing one of the most crucial method called the net present value. We are going also to be looking at the internal rate of return, the profitability index, discounted payback period, and then we normally have the modified internal rate of return. Later on, we are going to be looking on the criteria of making the decisions, the decision-making criteria, using all the investment appraisal techniques, which we are going to be looking at. Now, from there, we have to be looking on the problems and the difficulties encountered when making capital investment decisions, among other areas, which we have to be checking there for better understanding. We normally have financial statement analysis and forecasting. And in this area, we are going to be looking at the scope of financial statements analysis, major financial statements and other information sources, financial statement analysis framework, and users of financial statement and the information needs. And most of these areas, you will be able to check them in my notes. But most important and key areas which you need to be checking on is the ratio analysis. And the ratio analysis, we have to be looking on the nature of the financial ratios, the classification and the calculation of the financial ratios, and what are some of the limitations of the financial ratios. These are the areas which you are going to be enjoying fully. Now, for the people who are doing management accounting, which is also another unit which I normally teach, we are going to be getting some areas which we have covered under the working capital management. And that area you can see is under subsection 9.9, where you're going to be discussing about the management of inventory, what kinds of inventory, what is the objective of inventory management, techniques of inventory management, stock levels, economic quantity, and what is the meaning of just in time. Now, we also have some areas there discussing about the cash management. These are the motives of holding cash, techniques of managing cash management models, where we normally discuss about Baumol model, Miller Odd model, and we normally have Ogler's model. But later on, we are going to be looking on the management of accounts receivables and account payables, assessing credit worthiness, collecting amount owing, and also the trade credit. And when you look at it, these are the things, by the way, you are doing at the work levels as credit controllers for those who are working in those areas. Later on, we shall be able to check on the dividend decisions. In this case, we have to be looking on the Modigliani and Miller dividend relevance model. And when we are going to be checking on these areas, you must be very keen, because the dividend decisions, these are the areas you're going to be checking under the advanced financial decisions under the advanced level. You'll be able to check on things like Modigliani and Miller propositions under the advanced level, among other aspects. And then my last topic, which I shall be able to teach you as we finalize on this syllabus of ours, will be the introduction to the portfolio analysis. And in simple terms, I can be able to analyze the introduction of the portfolio analysis by looking on how you are not putting your money in one basket, right? I know very well there are people who are keeping money in certain banks, and in a way of savings. There are people who, in the same investment, they have taken their money to the fixed deposit account in a certain circle. There are people who have taken their money in the money market fund. And this is the combination, right? This is the combination of assets. And because the reason as to why we are doing this is to diversify the risk. So that is where we are going to be looking on what is the expected return at the end of the period, because you cannot be able to analyze the portfolio analysis and you ignore the risk involved in those investments you want to undertake. And when we are going to be measuring this risk, we normally use the coefficient of variation, right? Or the correlation coefficients, and also we normally use the standard deviation. Mostly, we can be able to pass through a certain corner where we normally discuss about the covariances. Well, I think that we have to be checking on there. Now, when you're going to be doing the portfolio analysis, and this is the area which I can be able or which you can attest. For those who have been repeating, I know that I have a student who told me, Mwalimu, I have been doing this unit for more than 4 times. And I want to help everyone that if you want to pass these exams, you need to be looking on the areas of the areas which you have to be basing or which you need to focus on. And this portfolio analysis, if you can just be able to analyze between 2022 and 2020, between 2020 and 2023, you'll be able to realize that every paper has a portfolio analysis questions. So it is very important for you to keep attention when you are going to be covering it. And that is the end of the analysis, because I said Islamic finance, I will be able to share with you. I will be able to share with you some notes there for you to pass through. Now, let me just move very quickly and discuss about the time value for money. It should be the time value of money, but let me just put it here correctly. The time value of money. And I have already analyzed the time value of money. But in a broader way, wacha nikupigie story kidogo about the time value of money. When you discuss about money, in the present, the money that you have right now is worth more than the same money, the sum of money to be received in the future. I know you will be able to say no, Mwalimu. That is not true. And in layman language, I will just be able to analyze about what is the time value of money. And the time value of money is just a basic financial concept that will be able to hold, or that hold that money in the present, right? In the present worth, which is worth more than the same money of the same sum of money to be received in the future. Now, this is true because money that you have right now can be invested and earn a return right now, thus creating a large amount of money in the future. Most of us, we normally say that the time value of money is sometimes referred to with the net present value of money. And that is what we are going to be learning as we progress with our syllabus. Now, a simple example can be used to show the time value of money. Assume that some of us to pay you one of two ways for some work you are doing for them, right? They will either pay you 1,000 Kenya shillings or pay you 1,100 1 year later. Which pays option will you take, Daniel? Which option are you going to be taking? Are you going to be taking 1,000 or 1,100, which is going to be paid a year later? I have asked you, and I have given you an example of the time value of money. That assume that someone offers to pay you one of two ways for some work you are doing. I have said that they will either pay you 1,000 now or pay you 1,100 a year later. And I have asked Daniel, are you going to run away with 1,000 or 1,100?
1,000.
1,000. Now, what about Mercy? Will you take 1,100 or 1,000?
I'll take the 1,000 because the 1,100 is the 100 shillings in a year is not worth the 1,000 bob right now. We'll take the 1,000 right now.
Thank you. But it normally depends on what kind of investment return you can earn on the money at the present time. So since 1,100 is 110% by the way of 1,000, then if you believe you can make more than 10% return of the money by investing it over the next year, you would you should opt to take 1,000 now. But on the other hand, if you don't think you could earn more than 9% in the next year by investing the money, then you should take the future value of 1,100 as long as you trust the person to pay by then. Now, the time value of money is normally it has some concept in the purchasing power parity, which you will be able to learn it when we go to the advanced level. Because the time value of money is also related to the concepts of inflation. And that is what I know right now. People who are having more cash flow are running so much in doing investments and looking for because they have some purchasing powers due to the inflation of the currency. Both factors need to be taken into consideration along with whatever rate of return may be realized by investing the money. So why is this important between the inflation and the purchasing power parity? And you can see, because when you look on the inflation constantly erodes the value of money and therefore the purchasing power of money. And it is the best exemplified by the prices of the commodities, such as the foods or gas, which we normally pay today. For example, if you are given 100 shillings in 1990, right? And you could have bought a lot more gallons of foods during that period. You could go to the market and buy much with 100 shillings. But if you are given 100 today, right, to go to the markets, you may not even buy anything of such a case. And that is why we are discussing about inflation and purchasing power must be factors in when you invest money, because to calculate to calculate your real return on an investment, you must subtract the rate of inflation from that from whatever percentage return you earn on your money, and that is what you're supposed to be doing now. In the rate of inflation is actually higher than the rate of your investment return, then even through your investment shows a nominal positive return, you are actually losing your money in terms of the purchasing power, right? For example, let me give an example. If you earn 10% on investments, but the rate of inflation is 15%, you're actually losing 5% in the purchasing power each year, right? I know now you have a very good concept in regard to the time value of money and what you need to be doing when you are making your decisions. Look on the investments, right? Look on the investments which you have to be doing, and look the interest rates. Then factor the inflation rates. And if the inflation rate is less than the interest rates, then invest. But if the inflation rates, right, inflation rate is more than the interest rate on the investment that you want to undertake, then run away. Let me just come back to what we are discussing today here. Something regarding to the time value of money. And I just want to say, these are the same concepts which I was able to analyze, which I said, it normally involves the determination of the future value through compounding and the present value through discounting of the expected cash flows. So allow me just to look at what are these compounding techniques which we can be able to use in the determination of the future value of the expected cash flows. And I will be able to say, this one normally incorporate two aspects. One, the future value of a lump sum and the future value of an annuity, right? And when you look on the future value of a lump sum, which is normally received once, right? We said lump sum will always once. And I said, if today you invest, let me look on, for example, let me talk about Juma is going to be doing his investments. Invest today 1 million, right? He person may invest, for example, I may invest within a period of 1 month, right? The interest which is going to be receiving is only once. Now, there are those people who are going to be investing 1 million in their accounts for the period of 5 years, but they said, capitalize the interest on my savings or on to be my principal amount. So it means year one, right? Juma was able to receive 50,000 from his investments of 1 million, sorry. Then he has not received this money in form of cash, but the company which he has already invested in capitalizes that money to his principal amount. It means the next period is going to be, when they are going to be calculating their interest, they are going to be calculated from 1,050,000 shillings, right? So it means, for example, if year one he was able to receive 50,000, year two he receives 65,000, it means that is lump sum. Each year has different interests. That is a lump sum. But when you talk about the future value of an annuity, it means I'm going to be receiving 50,000 continuously for the period of 5 years, right? But having the same interests. The interest is not going to be changing. And it means this interest is not capitalized in the principal, because when you capitalize on the principal, it means the principal amount, when they are going to be calculating it, they are going to be calculating on different figures, and the amount that you're going to be receiving should be lump sum. But the future value of an annuity, it means the interest and dividends which are going to be received, the cash flows which is going to be received, it is going to be the same, right? Those are the things that you need to be understanding. Several times it means the same amount. The same amount. If it is 30,000 for the period of 5 years, then that is an annuity. But lump sum, it means year one I received 20, year two I received 25, year three I received 30. That is the concept of the lump sum. But we are looking on the future value of a lump sum in a broader way, as I show you some examples. And we have said a lump sum means payment of an amount only once, either at the beginning, right, or at the end of the period. It may also include payment of irregular cash flows over a period of time. And when you talk about irregular, it means they are not similar. The cash flows are not similar. That is why we are talking about irregular. But when the cash flows are the same, also rather than using annuity, you can talk about regular cash flows. You can talk about regular cash flows. Those are the terms which I want you to be using as you describe the aspects of the financial management. Now, in this case, I just want to show you a concept here, right? A concept here. regarding to the future value of lump sum. And I know very well, this concept you are able to learn it when you are in high school. So let us go back to high school. We learn something here small. Let us learn something small here. I know very well that you can be able to see my board there. You can be able to see my board displaying the time value for money. It should be of money, right? And in this case, remember I want us to discuss the compounding techniques. I want us to discuss about the compounding techniques, right? We have said one of them, because the compounding is the determination of the future values of the expected cash flows. So let us start by looking on the future value of lump sum, sorry. The future value of lump sum. Then number two, we shall be able to look on the future value of annuity. So allow me to start by looking at the future value of lump sum, right? What is the future value of lump sum? And we are saying that the lump sum will be able to mean the payment of amount only once, either at the beginning or at the end of the period. This it means we receive only once. We receive only once. So in this case, we apply the compounding formula. We normally apply the compounding. We normally apply the compounding formula. We normally apply the compounding formula. We normally apply the compounding formula when determining. I know that you have your book and calculator by your side. When determining the compounding value, when determining the compounding value, we normally use the compounding formula when determining the compounding value over lump sum. Now, I remember there is something which we used to do in school. We used to talk about the amount. Should be equal to the principal. Is it the principal 1 plus R? We used to raise power N. We used to do something like this. And in this case, when we talk about the amount in financial management, the amount, it normally means the future value. The principal of years, it normally means the present value, right? The present value. When we talk about our R here, when we talk about our R, this is the interest rates. Because I know very well that you cannot invest in you cannot do an investment with these zero interest rates. Then we have N. We have to give our investment time. So here we talk about the number of periods. We look on the number of periods, stock time, right? Then it means the future value in financial management in an equal FFV. This one is normally the present value. That one is our present value in that regards. Now, it means our formula will be looking like what? The future value is equal to the present value. 1 plus R we raise power N. 1 plus R we raise power N. Let me look at an example here for better understanding. Let me look at an example here, and I say, if an amount of Kenyan shillings, 200 shillings, if Mercy is going to be investing 200 shillings, if 200 shillings is invested today, if 200 shillings is invested today at an interest rate of 10%, at an interest rate of 10%, at an interest rate of 10% per annum, 10% per annum, for a period of 5 years. For a period of 5 years, the future value will be, right? The future value will be, hata usitake kuelewa sana. Just go and tell your examiner, I know my formula which I'm supposed to be using here. I say, My future value is equal to the present value. 1 plus r we raise to power n, right? We say, I know my present value, which is, my present value is Kenya shillings 200, right? My rate, I'm being given 10%, and then our n should be equal to 5 years. Our n is equal to 5 years. So what is my future value in this case? And I say, my future value will be equal to what? My present value is 200. 1 plus 0.05, sorry, 0.1, we raised for 5 years. We raised for 5 years. Who is going to be giving me my answer here? Let me look someone else. Sijamkram jina yake here. Whitney. Now, what is our answer now, Whitney?
322 shillings and 10 cents.
Sorry?
322 shillings and 22.10.
Kenya shillings. 322.10.
10.
You can see there is a power of compounding in your computation. You see, 5 years ago, you were able to invest, you had 200. And after 5 years, at an interest rate of 10%, you are going to be getting 322 shillings and 10 cents. 322 shillings and 10 cents. You can see the power of compounding in that regard. Okay, let me look on a different illustration. Let me look at a different illustration. Before doing so, I just want to teach you something we normally call here NB. We say NB. NB, we say what? We say 1 plus r, we raised to power n. This is normally known as the future value. The future value, then you indicate in full. The future value interest factor. So when you are going to be writing it, but the formula for it you have seen here, it is normally written as the future value interest factor, R% n years. The future value, if it is for lump sum, this is how we are going to be writing it. The future value interest factor, R% n years. So in this case, let me have an illustration here, and I say, illustration number 2. So this is number 1. Number 2 here we say, if an amount of Kenya shillings. Let us use a very big figure. We talk about 120,000 is invested today. If an amount of 100 shillings, 120 is invested today at an interest rate of Kenya shillings. It is invested today at an interest rate of, let me talk about, at an interest rate of 15%. At an interest rate of 15% per annum for 10 years. At an interest rate of 15% for 10 years, the future value will be, when you're doing financial management, I want you to focus more of remembering your formula. You say, let me write my formula for better understanding. So that is my formula. So it means my present value today, I have 120,000 shillings. What is my rate? We say my rate is 15%. Then our N should be, what is our N now? 10 years. My N is 10 years. So what will be my future value? And they say my future value will be 120,000, 1 plus, right? 0.15. We raised power 10. We raised power 10. How much are we getting there? How much are we getting there, Daniel?
485,466.92.
You've told me 485. 485.
466.
466.
0.92.
0.92.
93.
Okay, that is the answer. And you can be able to see the power of compounding. 10 years ago, you had 120,000. You decided to invest at an interest of 15% per annum, right? For a period of 10 years. And then you are able to enjoy a return of 485,486 or 466.93. But I just want to introduce a different concept. And I say, let me say it here before I wrap the other side. I say, right? Determine, right? Determine the future value. Let us determine the future value of the investment above, right? Of the investment above, if interest was earned, if the interest was earned semi-annually, if the interest was earned semi-annually, and then I want you to explain, explain your answer. You explain your answer there, right? We have been told this investment which you have already discussed here. Let us look where what will be determine the future value of it. If the interest is going to be earned semi-annually, and then we are going to be explaining our answer. Now, when you get that question, because already it is there, my duster might not be looking good. So let me look for something else in 1 minute. In 1 minute. So let us continue. Not look clean now. Hope you'll be able to see what I'm writing. We have said, let us determine the future value of investment above under example 2. If the interest was earned semi-annually, and then we are going to be explaining our answer. In simple terms, you just come and you tell me, right? The first thing that I want to do is to write my formula. Right? What is the investment? The investment is worth 120,000 shillings. The investment is worth 120 shillings. Then you ask yourself, how is my rate how is the rate affected? We say, if we are discussing about semi-annually, if we discuss about the semi-annually, it means this interest which we have already been given here is for the whole year. And it means the interest which I'm going to be receiving, I'm going to be receiving twice. I'm going to be receiving interest twice in a year. So it means in 6 months, our rate will be how much? You tell me it will be 7.5. Then I talk about how is my period affected? How is my period affected? If, for example, in a year napata twice, na niko na miaka 10, what will be my period? I say, I just need to take 10 times 2. This is 20 periods. I hope I have not confused you. I've said the interest is going to be received semi-annually. Semi means twice in a year. So the interest for 6 months should be 7.5, right? And in a year, if you receive twice and you have 10 years, it means you're going to be receiving this interest for a period of 20 periods or 20 times, right? So to determine your future value, I can say, let me take 120,000. I multiply by the future value interest factor, 7.5%, 20 periods, right? I can be able to say 120,000. I multiply it by 1 plus R, which is 0.075. We raised power 20. We raised power 20. So how much are we getting out of this? We say, Mercy can give us the answer. What is our answer right now? What is the answer right now? What is our answer right now?
I cannot calculate. I'm still on the matatu.
Oh, sorry. Someone else?
509,742.13.
Sorry, come again.
509, 509, 742.13.
Okay. 0.13.
Yeah.
So can you give me the difference between your answer right now and the answer which we computed earlier on? What is the difference? You can be able to tell me here, the difference is because of the compounding effects. The difference is because of the compounding effect. That is, anytime, right? Let me just explain further. Anytime after the first period, interest is earned. Interest is earned on interest. It is earned on interest and principal amount. It is earned on the interest and the principal amount. Right? Principal amount invested. And that is what I was able to explain earlier on. So the interest that you're going to be getting all the time, you're going to be incorporating, right? The principal invested. Now, I know that you have already understood the concept of the future value of lump sum. The future value of lump sum, I think, is well elaborated, unless there is a question. Unless there is a question. Is there a question? Daniel. Daniel?
No question. No question.
No question. No question. Ezra. Is it Ezra or Juma? It is Juma.
I'm okay, no question.
Thank you. Thank you. So let us look on the other technique, which you talk about the future value of annuity, number 2. We are looking on the future value of annuity. And when we discuss about annuity, it means several times. When you'll be able to hear something regarding to annuity, it means several times. It means several times, right? And this, it means the payment of the fixed, the period amount of a given period or intervals, right? So let me look on an example here, because we know what we are talking about for better understanding. So example, let me start with example number 1. Number 1, if an amount of Kenya shillings, 200 is expected now. If the amount of 200 shillings is expected at the end of each year, it is expected at the end of each year, over a period of 4 years. Over a period of 4 years, at an interest rate, we can use at an interest rate of 10%, right, per annum. its future value would be, so tutacalculate aje hii, its future value itakuwa namna gani? And remember, there are terms which are now changing in this case. We are discussing about the end of each year. Be very keen. At the end of each year. So when you are computing your question in this case, you can be able to use this option. So let me talk about the end of year. We have the cash flow here. My cash flow is in Kenya shillings, right? Then we have the future value interest factor annuity, R% N years. Correct. So the investment of ours is taking 4 years, right? The investment of ours is taking 4 years. And at the end of year, because that is what we are being told, at the end of year, we are expecting 200 shillings. Or we are investing 200. Yeah? We have a very simple question here. Kila mwaka, at the end of each year, I invested 200, right? Now, my 200 here, itakaa kwa account for how many years? Let me listen to someone. Mercy. Hii pesa yangu hii, itakaa kwa account for how long? Is it 4 years? Whitney? Whitney?
3 years.
Uko mbali sana, I cannot hear you. How many years?
3.
3 years, very good.
3.
So when you're computing here, you say 200, 1 plus R, which is our rate, 0.1. You raise for 3. This one now it will be 2 years. I say 2, 1 plus 0.1. I raise for 2. Then this one will be 200, 1 plus 0.1. We raised for 1. Then the last one will be 200, 1.1. I raised for 0. I think we are in agreement for that. So what is the answer for the first one? What is the answer for the first one? Who's giving the answer for the first one? Hello?
266.2.
266.2.
Yes.
The second one?
242.
242. Is this 220?
220, yeah.
And this is 200. That one is 200. So what is our answer there?
$928.2.
928.
Yes.
928.2. Now, alternatively, we have the formula for this computation here, and we say the future value interest factor annuity, R% in years. We normally get it by taking 1 plus R, we raise power n minus 1 divided by R, right? So in this case, we can be able to say, if directly I could just take 1 plus 0.1, I raised power how much? We raised power 4 minus 1. We divide it by, is it 1? Yes, it should be. We divide it by 0.1. Then we multiply by our principal amount, which is 200. Hebu tuangalie kama tutapata 928.2.
Yes.
Okay. Remember utapata the same 928.2. 928.2. 928.2. Now, I think in that case now, let me see something here. Let me confirm something, whether we have a question from our past paper. Let us look on December 2022 question. There is a question there. Let me open it first. So let me look for that question for better understanding. December 2022, right? We have question 1C. Someone to read for us, please. Someone to read for us. Ladies first. Ladies first. Anyone there?
Your client, Alfred Otieno, wishes to invest 500,000 for 2 years with interest compounded, but with the right to withdraw at a moment's notice. The following investment options are available. Option 1, invest with Nyumba Building Society, currently offering an interest rate of 14% per annum after tax, with interest paid half yearly. Option 2, invest with Kijiji Bank Limited at an interest rate of 17% per annum with interest paid annually. Option 3, invest with Faida Bank Limited, which is offering 16% per annum, interest paid every 3 months. Required, using suitable computations, advise your client on the best investment option he should consider.
Thank you. Now, before we shift our attention to the discounting technique, let us first look on this question, which are already tested under the future value of compounding, and we are already being told that down there that Alfred Otieno, who wishing to invest 500,000 for 2 years, but with the right to withdraw at a moment's notice. The following investments we are already been provided there. The first one is we invest with Nyumba Building Society, currently offering an interest rate of 14% per annum after tax with interest paid up yearly. The other one is we have been told in option 2 that invest with Kijiji Bank Limited at an interest rate of 78% per annum. The interest is going to be paid semi-annually. Sorry, it's going to be paid annually. Then the last one we've been told we are going to be investing with Faida Bank Limited, which is offering 16% per annum. Interest is going to be paid every 3 months, right? So in this case, we are going to just be looking on each quarter, and we look on the one which is going to be giving us a better future value, right? So in this case, I'll go back to my board here. I know that you have these question with you. So we are discussing about the determination of the future value. And in simple terms, I will be able to start with the option 1. Let me start with the option 1, and I'll just be able to write my formula where I say the future value is equal to the present value, 1 plus n we raised to power n, right? 1 plus r we raised to power n there. Now, in this case, I'm going to be looking on the terms provided there by an examiner. And the terms I can see, we are being told we invest with the building society, which is currently offering the rate of 14%. What is the amount first, right? Not the amount, but what is the principal amount? What is the principal, the present value of ours? We say our present value is equals to 500,000. What about the rates? We factor the concept of the semi-annually, twice a year. So it means we're going to be dividing our 14% by 2. 14% we divide by 2, we get 7%. Then the number of periods increases, right? From 2 to 4, 2 times 2, which we get 4 periods. We get 4 periods. So to determine the future value in this case, we just take our present value, which is 500,000, 1 plus our rate, which is 0.07, we raise to power 4. How much is the answer for the option 1? It asks me, as I analyze option 2, what is the answer for option 1? What is the answer for option 1? What is the answer for option 1? Hello? If you have the answer, just say it. What is the answer? Through my calculator, I can see we have Kenya shillings, 655, 390. I just want to round off the decimals. Now, under option 2, we are being told, invest with Kijiji Bank Limited. Thank you, Daniel. Invest with Kijiji Bank Limited at an interest rate of 17% per month, per annum, with the interest paid annually. So this is going to be very simple for us. Because we say the future value of ours, we take the present value of 500,000, 1 plus 0.17, we raise to how much? We raise to power 2. So it means it is 1.17. We raise to power 2. We multiply it with 500,000. We get 684. 450. Then we look on the option 3. Right? How does the option 3 need? It says, we invest with FIDA Bank Limited, which is offering 16% per annum, interest paid every 3 months, right? Interest is paid every 3 months. So what is going to be affected here? It is rates, which is 16%. Kama interest yako inalipwa after every 3, tuko na quarter ngapi? We have 4 quarters in a year. So after 3 months, rate yetu inapaswa kuwa 4%. What about the period, which is N? Our period will be 2 we multiply by 4. Because a year has 4 quarters, so we are going to be having 8 periods. So to get the future value of yours, you're going to be taking the principal amount, ama the present value of 500,000, right? Then we multiply it with 1 plus our rate of 0.04, we raise it to power 8. How much is your answer? And we can be able to take our calculator and do the math. We multiply by 500,000. We get 684, 285. Whitney, which option gives you the higher returns? Right? we say, when you compare between the three, you can just be able to
Option C.
say, option 2 is recommended. The option 2 is recommended since it offers or it has the highest return. Option 2 is recommended since it has the highest return. We have question number 2 here because option number 1 is done. Option 2, we are being asked by the examiner, right? We are being told, calculate the effective rate of interest for option 1. The effective rate of interest. And I'll just be able to come in and say, under option 2, is it option 1? Yes. I just need to look on what is the future value? And I can see the future value is around 655. So to get the effective rates, what do I need to take? I take 655, 390, which is equal to the principal amount. This is option 2. The principal amount of years is 500,000. We take 1 plus our rate, which now we want to compute it. Then we raise to the period. Our period is 2 here, right? The period is 2. Let us divide both sides by, we divide both sides by 500,000. You divide both sides by 500,000. Right? What are we getting right now? What are we getting here? So I take 655, 390. We divide by 500,000. We are getting 1.31078, which is equals to 1 plus r we raised to power 2. If we want to remove this power here, we can only opt for a root. And in this case, it will be 2 you put there, 1.31078. You get your 1 plus rates. 1 plus rates. So how am I going to be doing all this? Correct. So some of us will be able to opt and say, let me press the 2 from the keyboard in my calculator, right? Then I press shift. Then there is a button in that calculator of yours, which has that as a mark. Atatumia shift, ataandika 2, then afinye shift and this button. Atakuwa na 2 ka x and ka roots. Then you put your answer inside there. Right? It is 1.31078. I'm getting something closer to 1.145, which should be equal to 1 plus r. Take this one to other side. It is going to be looking like this. 1.145 minus 1 is equal to the rate. So what is our rate here? Our rate should be 14.5% if you multiply that amount of years by 100%. You're going to be having 14.5%. That is how you normally compute your effective rate of interest for that certain option provided there. Then the third requirement, you're being told, we identify 2 situations that could affect your recommendations in say 1 above. You have a lot of points in which you can be able to put under this consideration, right? 1, we discussed about inflation, and I know right now you can be able to explain it with a lot of words. The other one might be the risk of the market, right? The risk of the markets. Then number 3, you can just also be checking on the attitude. The attitude of the investors. The attitude of investors also plays a key role in any kind of investment you want to undertake. Now, I just want us to check on something else. let us go to the discounting technique. Let's go to the discounting techniques as we conclude. Let us go to our notes now. Okay, now under the discounting techniques, I just want to take you back to where we were. We were discussing about the compounding techniques. Now, from the present to the future. Now, we are going to be coming from the future to the present. That is the difference between the two. We take the future to the present to determine, for example, kama Daniel alikuwa and I expect to receive. And those are the things which are already, we normally discuss them at an advanced level there. When we are discussing things like international financial derivatives, the bank can promise you money for the future periods, right? Then you ask yourself, how much am I supposed to be investing today? That is a game of words now. From that point is where the discounting techniques normally comes in. And we have already said that it involves the determination of the present value of the expected future cash flows and is the opposite of compounding. And it is normally done in 3 phases, right? The discounting techniques is normally done in 3 phases. So the first one will be, the first phase will be, we are saying that they normally include, they normally include the present value of lump sum, the present value of annuity, and then we normally have the present value of annuity to infinity. So let me just be very quick as we discuss about the present value of an annuity. Let me check. Okay. Good. So let us look on the present value of a lump sum, right? And we are saying very well here, lump sum means payment of a fixed amount only once, either at the beginning or at the end of the period. And we have said the present value, that is an example which is already given there. And I will just be able to work for you, for you. Now, in this case, remember we are dealing with only 3 things here, right? We are dealing with only 3 things because we are doing the discounting techniques. Let me simplify them for you. The discounting techniques, there are only 3. Number 1, we are talking now, remember last one, we were discussing about the future value. Right now, we are discussing about the present value of lump sum. The second one will be the present value of annuity. Then the third one will be the present value of annuity to infinity. So let me start with the first one. We are discussing about the present value of lump sum. The present value of lump sum. And when we are discussing about the lump sum, we talked about receiving any money, any interest only once. It is not going to be changing whether you are doing the lump sum, whether you are doing the annuity or you are doing the lump sum, whether you are doing the compounding or the annuity concepts. Now, in this case, let me just give an example here. Let me give an example here, and I can say, if the present value of Kenya shillings, 300, if the present value of 300 is expected, if the present value is expected after 5 years, if the present value is expected after 5 years, right, at an interest rate of 10%, right? right? Right. The present value, if the present value, what am I putting here? Right. If the present value of 300 is expected after 5 years at an interest rate of 10%, let me twist the question. If the future value of 300 is expected after 5 years at an interest rate of 10%, the present value will be, and I will be able to say, can we be able to recall? Can we be able to recall the future value of ours we used to take the present value, 1 plus r we raised to power n. And I will just be able to tell you, can you be able to make the present value the subject? And in this case, I say, to get our future value, we are going to be taking the present, 1 plus r raised to power n. Divide both sides by what? 1 plus r raised to power n. Here we divide by 1 plus r raised to power n. So the present value will be equal to the future value over 1 plus r raised to power n. Or this formula, you can write it like this. You can take the future value, 1 plus r, but you raise to power negative n. You reciprocate your formula. And this is what mostly is normally used. That is what is normally used. Now, in that case, when I write my NB here, I say, this is what is normally called the future value, right? 1 plus r raised to power n, right? There should be 1 plus r raised to power n. It is normally, it is also known as, the present value interest factor r% n years. Na ndio tumeanza kufanya mtihani sasa. Hapa I know very well. You have seen this formula at the back of the papers of FM, this one. And then you are able to see 1 plus r raised to power negative n are those papers. So it is very keen for you to understand what you are doing here. So in simple terms, we say, and I like students to know how to use the formula rather than looking on them there. But I will be able to show both of them. Now, in this case, to get our present value, we are going to be taking, for example, the future value, which is 300, 1 plus our rates. The rate which you are given is 0.1. We raised for a negative what? We raised for a negative 5. How much are we given here? How much are you getting there? How much mistake can you get in that case? 1.1 you raised for negative 5 times 200, or 300, sorry. So it means in 5 years back, you invested Kenya shillings 186.28. In your pesa will invest 5 years ago, so that you can arrive unaweza pata 300 in future. And that is why I told you, you might be given the future to determine the present value. How much are you supposed to be investing in a certain period? Now, let me look for another illustration here, and I say, determine the present value of Kenya shillings 100,000 over 100,000 expected after 5 years. Expected after 5 years at an interest rate of 12%, right? At an interest rate of 12%. What are you supposed to do? And I say, this one is supposed to be talking about, to determine your present value, you need to take the future value of ours, which is 100,000, right? We multiply by 1 plus the current rate, which is 0.12, we raised for -5. Now, in this case, you can see we are taking 100,000, you multiply by what? 100,000, you multiply by what? There is something I want to show you there. Now, it is 1.12, we raised for -5, getting 0.56, 0.5674. 0.5674. Let me just shift you to our past paper here. Wacha tuangalie a table here. So when you look on this table, the table is here. Wacha tutafute moja. If we can get a table, good. You can see we have a table here for the present value of one received at the end of n periods. So when you look on your period here, this one, the period is 5. Then you match it with the with your rates. Currently, our interest rate is 12%, right? And you can see we are getting 0.5674. 0.5674. So you can be able to look at these at the back of your paper, past papers, and these are the interest rates or the discounting rates which are going to be receiving. So if you take 0.5674, we multiply by 100,000, you're going to be getting Kenya shillings. This person 5 years ago, he invested Kenya shillings 56,740. 56,740. 56,740. That is the amount he was able to invest 5 years ago. 5 years ago. 5 years ago. Now, we also have a concept here which discusses about, let me check another example, discussing about, let me give a third one as I look on other discounting technique. I say, we calculate the present value, calculate the present value of 5 million shillings, expected after 8 years, expected after 8 years, expected after 8 years, if the cost of capital, is 20%, and the interest is earned semi-annually. And the interest is going to be earned semi-annually. So what are you going to do in this case? We say, when I hear these terms, I have to take the analysis of the interests and the years. Now, in this case, it means my years will be 8 times 2 because the interest is earned twice in a year. So how many periods are we going to be having? You talk about 16 periods. What about the rates? We say this is 20%. You divide by 2 to determine for 6 years interest rates. So to determine your future value, sorry, the present value, we say let us take our 5 million shillings, right? 1 plus our rate, which is 0.1, we raised for -16. We raised for -16. How much are we getting here, Mercy? You told me uko matatu. How much are you earning there? How much is the answer?
1,088,145.68.
Call it 1 million.
88,000.
1,088.
145.
145.
0.68.
0.68. 0.68. 1 million 8 years ago, we invested 1 million and 88,145 shillings. So that the future value will be 5 million. The future value could be 5 million. Na najua hii ndio kazi mingi sana insurance inawafanyianga. Inakuambia if you invest a certain amount, in future utakuwa na 10 million. Unaanza kujikuna kichwa. This is the job for insurance companies. With all due respect, I would ask you we stop at that point so that the next time when we are meeting, we shall be able to discuss about the present value of annuity. The present value of an annuity, and the next time we are going to be meeting, we shall finish up with the present value of an annuity, the present value of an annuity to infinity, then we compute the loan amortization schedule, and if time allows, we shall be able to get to our second topic of discussion. Any question? Any question? Any question? Any questions so far?